Have you ever thought about why some people invest in the stock market and seem to get rich quickly, while others have a hard time making ends meet? What if I told you that anyone can learn how to make money in stocks with the right information and plan? Come with us as we delve into the world of stock market trading and reveal the tips and tricks that can help you make a lot of money from your investments. Are you ready to reach your financial goals and use your wealth to its fullest? Keep watching, and we'll show you how to start making money in stocks right away. First, buy and hold. When it comes to long-term investors, there is a proverb that goes, "Time in the market beats timing the market." What exactly does that say? When it comes to making money in the stock market, one of the most common ways to do so is by employing a buy and hold strategy. This strategy involves holding stocks or other securities for an extended period of time rather than engaging in frequent buying and selling, often known as trading. Because investors who constantly trade in and out of the market on a daily, weekly, or monthly basis have a tendency to miss out on possibilities for large annual returns. This is a crucial point to keep in mind. Do you not believe it? Take into consideration this. According to Putnam Investments, investors who maintained their full investment in the stock market for the 15 years leading up to 2017 had a yearly return of 9.9%. Nevertheless, if you entered and exited the market on a regular basis, you put your prospects of achieving those gains at jeopardy. The annual return for investors who missed merely 10 of the greatest days during that time period was only 5% that they received. Those who did not participate in the 20 best days saw a return of only 2% on a yearly basis. The failure to take advantage of the 30 greatest days really resulted in a loss of 0.4% on an annual basis. It should come as no surprise that missing out on the market's most favorable days results in much lesser returns. It is impossible to forecast when those days will occur, and days of excellent performance can sometimes follow days of huge declines. Although it may appear that the simple approach is to constantly make sure that you are invested on those days, this is not the case. In order to ensure that you are able to capitalize on the stock market at its peak, it is imperative that you remain involved for an extended period of time. A buy and hold strategy is one approach that can assist you in accomplishing this objective. In addition to this, it helps you when it comes time to file your taxes because it makes you eligible for lesser capital gains taxes. Invest in mutual funds rather than individual stocks. The technique of diversity, which has been around for a long time and has been proven to be effective in lowering risk and perhaps increasing returns over time, is something that seasoned investors are aware of. One way to think about it is as the equivalent of not putting all of your eggs in one basket when it comes to investing. Individual stocks and stock funds, such as exchange-traded funds, ETF, or mutual funds, are the two forms of investments that the majority of investors choose to put their money into. However, in order to achieve the greatest possible level of diversification, experts normally advise investing in stock funds. Even though it is possible to purchase a variety of individual stocks in order to simulate the diversification that is automatically provided by funds, doing so successfully may require a significant amount of time, a fair degree of investment expertise, and a significant financial commitment. A single share of a single stock, for example, can be purchased for a price that can reach hundreds of dollars. On the other hand, funds enable you to purchase exposure to hundreds or thousands of individual investments with only one share of ownership. Despite the fact that everyone wants to put all of their money into the next Apple or Tesla, the plain fact is that the majority of investors, including the professionals, do not have a solid track record of predicting which firms will provide outsized returns. The majority of consumers should invest in funds that passively track large indexes, such as the S&P 500 or the Nasdaq, according to the recommendations of financial experts. By doing so, you put yourself in a position to profit from the approximately 10% average annual returns of the stock market in the most straightforward and cost-effective manner imaginable. Reinvest the dividends you receive. There are a lot of companies that give their shareholders a dividend, which is a payment that is made on a regular basis dependent on it. Although the little sums that you receive in dividends may appear to be insignificant, particularly when you are initially beginning to invest. In order to take advantage of the accelerated compounding that occurs, many financial experts advise long-term investors to reinvest their dividends rather than spending them when they get the payments. simply by enrolling in a dividend reinvestment program, also known as a DRIP. The majority of brokerage firms will provide you with the opportunity to automatically reinvest your dividends. Make sure you pick the appropriate investment account. When it comes to the profitability of your long-term investments, the precise investments you select to hold are certainly significant. Nevertheless, the account you choose to hold them in is also quite important. It is due to the fact that various investment accounts provide you with the opportunity to take advantage of specific tax advantages, such as tax deductions at the present time, conventional retirement accounts, or tax-free withdrawals at a later time. While the money is being held in the account, you are able to avoid paying taxes on any profits or income that you earn. This is true regardless of whatever option you choose. Due to the fact that you can postpone paying taxes on these good returns for decades, this can provide your retirement savings a significant boost. However, there is a price to pay for these advantages. In general, it is not possible to withdraw money from retirement accounts, such as 401k or individual retirement accounts (IRAs), before reaching the age of 59 and a half, without incurring a penalty of 10% in addition to any taxes that you are obligated to pay. Of course, there are several situations in which you are able to use that money early without incurring any penalties. These situations include dealing with the economic consequences of the COVID-19 epidemic or dealing with the heavy medical bills. Once you have deposited your money into a retirement account that offers tax advantages, you should not access it until you have reached the age at which you are eligible to retire. This is the usual rule of thumb. On the other hand, regular taxable investment accounts do not provide the same tax benefits as tax-advantaged investment accounts, but they do permit you to withdraw your money anytime you want and for whatever reason you want. Because of this, you are able to take advantage of some methods, such as tax loss harvesting, which involves turning your failing stocks into winners by selling them at a loss and receiving a tax break on some of the gains you have made. You are also able to contribute an unlimited amount of money to taxable accounts in a single year. However, there are annual limits on contributions to 401k IRAs. All of this is to imply that in order to maximize your returns, you need to be sure that you are investing in the right account. If you are looking for a location to store your investments that normally lose less of their returns due to taxes, or for money that you may require in the next few years or decade, taxable accounts might be a smart option for you. On the other hand, assets that have the potential to lose a greater portion of their returns due to taxes or investments that you intend to retain for an extremely extended period of time may be better qualified for tax-advantaged accounts. A majority of brokerages, though not all of them, offer both types of investment accounts. Therefore, you should be sure that the brokerage of your choosing offers the account type that you require. In the event that yours does not, or if you are just beginning your adventure into the world of investing, you can choose the finest brokerage for you by consulting Forbes Advisor's list of the best brokerages. You don't have to spend your days betting on which specific firm's stocks might go up or down in the short term if you want to earn money in stocks. You can make money for yourself by investing in stocks. In point of fact, even the most successful investors, like as Warren Buffett, advise potential investors to put their money into low-cost index funds and to keep such funds for a number of years or even decades until they want their money. Consequently, the tried and true method that has proven to be successful in investing is, unfortunately, a little bit monotonous. Instead of rushing after the most recent trending stock, you should simply have patience and trust that diverse investments, such as index funds, will become profitable over the course of time. Ready to take your financial future into your own hands? Subscribe now to our channel and never miss another tip or strategy for making money in the stock market. Start building your wealth and securing your future today.